Hello everyone and welcome back to Crypto Oracle. So today we're going to talk about the current macroeconomic outlook and what to expect from the market going forward with our expert, macro expert, the Risk Oracle. How are you?
Hi guys, welcome back everyone. I'm doing great. What about you?
Good, thanks. So how about, do you want to start giving a overview of what we're going to talk about today and all the topics we're going to touch in this episode?
Yeah, sure. So yeah, today we're focusing a bit on the macroeconomic situation. So we're gonna go through the inflation rate, some key indicators. So the inflation rate, the unemployment rate, the recent hike in interest rate by the Fed, and yeah, the implication of the yield curve and so on. So really stay tuned because this is going to be a really interesting session. Yeah, and yeah, I think we can start by looking at the inflation rate. So we basically saw from the market that we have a 7.9 inflation rate in February 2022, and yeah, also this is all in part caused by the COVID-19 pandemic, but also by um, the commodity prices, which are skyrocketing after the Russian invasion of Ukraine. So, what are your views on the current market situation and specifically about the inflation rate?
Yeah, thanks. So, yeah, my general view is actually all the consequences of the just recent Russia and Ukraine conflict are still not priced into the inflation. So the inflation print that we had in February was about 7.9%, and I think it was mainly the consequences of the supply shock problem that we have in the past, and all the consequences of definitely all the money printing by the Fed, so the so-called quantitative easing, so purchase of assets, creation of new money injecting in the economy, which is about like 40% of new money injecting in the economy. And yeah, I think that in going forward we're probably gonna touch double digit because this February print didn't include the recent spike of commodities prices that was consequence of the Russia conflict. So, but in general, like my general consideration is our inflation is only 7.9% when we've seen all across the country, all across the world. Definitely prices increasing, but much more. We've seen like rents going up 19%, house prices going up in general 15%. We've seen like even the our grocery bills is definitely much higher than just 7.5%. So in general, I think like, and I did some digging, and if we were actually using the same way of measuring inflation of the 1980s today, the actual number of CPI, so consumer price index, would be actually 14-15%. So why is it so low? Are they actually changing the number? What are they doing to keep it so low? So basically, they are just changing the way that they are weighting different price. So that's consumer price index, just like goods or prices with different weighting, and they see that they're increasing at different prices. So they just change the weighting of different goods, so making it look way less. And then one of the main reasons as well that I see why this number is so low is that 33% of the actual inflation, the CPI index, is shelter. So shelter is houses, and I just said that the cost of houses just went out like 15-20%. So, and in the actual print, there is reported 4.4%. So I was thinking like, are they changing a number like that? How can they do some like these? And then I actually see how they measure the shelters, so the price of housing, and they actually do it every 6 months. They go reassessing every single house, so the actual consequences, the actual price of the increase of price just shows up slowly. So we're gonna see these actually these components increase and get the increase of the CPI going forward. So yeah, I mean that's my general outlook on inflation. I think you are the macro expert, so do you wanna give outlook of what is the macroeconomic situation is right now rather than inflation? Are we in a strong situation? How's the economy doing? We see like decent price like earning of companies, but what should we expect going forward?
Yeah, sure. So basically, like as we see from also from the chart here, we have like high like a spike in inflation. But apart from that, the situation is not looking too bad. Like now with the Russian conflict, the Russian invasion, the situation might change. But like if we focus on the situation just before that event, we were basically facing a strong economic growth. The unemployment rate was going down. The stock market kept rising since the big crash of March 2020. The Fed rate, like the interest rate, the Fed funds rate, which is basically the normal interest rate, the basic interest rate which banks have among them, it was like around 0%. So basically, every sign was pretty good, pretty good prediction of what the economy could go. But yeah, the main issue right now is this inflation rate, which is really underestimated, as you said before, and this really is a big problem. Uh, this is a big problem also, especially given the recent boost of energy prices, which at the end affect dramatically low and middle income families. So the Fed necessarily needs to deal with this, needs to find solutions in order to decrease this inflation rate, which is actually by any means, which is not actually by any means sustainable by the low and middle income families. So the main thing here would be to rise interest rate. And yeah, basically, recently the Fed has announced a series of hikes across during in each of their following meeting they're going to have this year, and these hikes are going to be by 25 basis points, which is not that much actually, considering these extremely high inflation figures. But yeah, concerning the possible economic scenarios that this measure is going to have on the markets, well, actually, if we go back to the basic economic intuition, when Fed rises interest rates, we have a higher cost of capital for firms, basically. So this higher cost of capital is meant to decrease the economic activity of firms, and in turn, this would eventually decrease inflation. And yeah, so basically, the main measure that the Fed can act is a rising interest rate. But then, what does this mean for the entire economy? So basically, the firms would have higher cost of capital, which means in turn higher costs, higher total cost for the firm, and eventually they would need to decrease this cost in order to remain profitable. So the easiest way to decrease costs is to cut on workforce. So, well, my intuition would then be that the unemployment rate could potentially increase in the medium short term because of this rise of interest rates, and also the economic activity, so the economic growth could see at least a slowdown. And yeah, of course, we have in macroeconomics we have a scenario which is kind of catastrophic, because there's not really any measures, any policies that the Fed or the central bank, the ECB, can elaborate, in order to slow down, like in order to counteract this phenomenon. And this phenomenon is basically stagflation. So stagflation happens when we have rising inflation, rising unemployment, and decreasing economic growth. So basically, what we can maybe this actually is a possibility. This is an actual possible scenario that the world economy could face in the future, if the rise in interest rates is not as effective as it should be to drive down this really high inflation rate. So basically, this is one scenario that we elaborated and that we think is kind of likely to happen. But yeah, this is really still uncertain given the entire economic situation. There's a bunch of variables that could affect these results, such as the war in Ukraine and everything like that. But yeah, if we go to the next slide, we also saw that we saw a good and a huge boost in the energy prices. So I mean, what's your view on this? Like from the chart, we saw that since the 2020, which is incredible, the cost of a 1 barrel of oil was around $15, and now it's like 10x. It's crazy, no? It's like it's something really that the Fed needs to deal with this, because it's something crazy.
Yeah, I agree. Like, we would have thought, like, during the 2020 pandemic, that oil was gonna rise so much. Like, people were not using cars, people were not even traveling. It would have been one of the best probably investment decision. Like, you definitely could have seen it's happening. Like, the people were gonna start going back to using cars, and fly was gonna start happening again. But you wouldn't expect this very high, this very recent spike. I think this recent spike is definitely caused by the uncertainty given by the Russian-Ukraine war conflict. Because especially we know that Russia is like probably the third biggest exporter of oil, producer of oil, and yeah, that's definitely one of the main problems. And we see all these financial sanctions that they makes trading with Russia very hard, and as a consequence, we see the price of oil spiking up very high, and we see on our normal lives actually the price of gasoline go like increasing, and our bill on our gas is going up exponentially. So yeah, I think all the people that thought that inflation was going to be transitory, now they're realizing that this inflation is actually structural. So it's not just staying here for the short term, but it's gonna stay for a long time. Especially like the main problem is actually structurally from supply problems. So as you rightly highlighted before, and the main way they are trying to reduce inflation is actually combated with rising rates, and so they can reduce demand. The demand doesn't put more inflationary pressure on the supply itself. So they're trying to reduce demand to keep price stables and keep inflation under control. But yeah, I think they're definitely gonna be able to reduce inflation, maybe to a lower target. But I see around like 4 or 5% inflation stable for the next one year at least.
Mm-hmm. Yeah, and it's also interesting to have a look at how the economy performed during this period of rising interest rates. Like, I think we have a few slides on this, and it's really interesting to go over them.
Definitely. Like usually, like what intuitively you think, okay, we're gonna the economy is gonna slow down. We like inflation is gonna hit. We're gonna reduce demand. But actually, what usually happens, and what on the market is that the market actually performed pretty good during this period of hiking of rates hiking. So I think the general consideration to do here is that these things take time to happen. So you actually see the consequences after the hiking cycle, when the actual recession kicks in. So we can see here in all the different hiking cycles from 19 to 2000, actually the stock market first like priced in all these rates, and it corrected, but then it actually performed pretty well, because the actual liquidity on the market and the actual economic outlook was actually pretty healthy. It will still take time to have these kind of consequences. So the same happened for 2004, 2008, and we all know what happened in 2009. So you actually see the recession happening the moment the Feds start pivoting, because they see that the situation is going south, so they cannot tighten anymore. So that's actually when it's going to happen. So I think we all think that a recession is definitely in the card, that will probably happen in around end 2022, 2023. But now I think the situation on the market is pretty healthy, and we probably well set up for a decent bounce up in the short term.
Mm-hmm. But do you and also concerning this, do you think like what's the highest amount of interest rate like that they're gonna achieve in order to reduce inflation? Do you think the interest rate are gonna rise like till 10% at least, or do you see it like stabilizing around 4 to 5%?
Yeah, I think the market price in right now around 5 or 6 interest rates. And Goldman Sachs even came out saying they expect like 10 or 11. And yeah, I think they're definitely possible. But then, as we can see from the past, every time the market actually started tanking, the Feds actually pivoted straight away. And every single time they did this tightening, the actual level they got to of interest rate was lower and lower and lower. So the last time was actually 2.5%. I think we have a beautiful chart next here. Yeah, the 10 years treasury healed, and then we can see a kind of downtrend here, and the imaginary resistance that every time the Feds have to pivot, and because the system couldn't take such a high interest rate. And I think that the main reason behind it, and as we've seen, the system is definitely over leveraged. Like we've seen what happened in 2009 on like this credit bubble, and then with this negative cost of capital, with this very, very real negative cost of capital, low interest rate, the system is addicted to cheap financing. So the moment you rise rates, what before like for a firm was like it was sustainable to have a 1% yield, a 1% payment on a debt. Now, if it's 2%, they actually have to cut spending by half because they can afford half of what they were affording before. So I think the whole house of cards just comes down when and all the inflated growth that we can see all around just because of this easy capital cost of financing just comes down, and we can see all the things coming down very soon. So I don't think it's going to be very possible for the Feds to rate hikes more than 2.5%. And yeah, another last consideration I'm gonna do about this, and it's not only firms and companies that are over leveraged, but this time is actually the actual country. The debt for GDP is like 140%. So we've seen like one of the every time there is this boom and bust of credit expansion and contraction. Actually, at the end, we put like a 9-year low. So there is a macro trend which on debt that is playing out now, which is a global sovereign, so state debt bubble. So now the amount of state debts is so high that the actual state cannot even allow rates to go so high because they won't be able to respect the payments. So like if we see now already the payment of treasury spending is around 65% of tax receipts, and imagine rates go up to 10% to actually combat inflation. Like they will go up like to 100% of tax receipts, and then how do you pay everything else like defense, wealth and welfare, entitlements? So yeah, the main problem is like they can't allow this to happen, and I think right now we're already seeing the market reacting to these the Fed hiking rates, and one of the signal that usually help us understand gauge the current situation is the yield curve. So I wanted to ask you if you what's your thought? What's the situation about it? Are we seeing what do normal like people need to understand from the yield curve to actually understand what's going on in the economy, how they can use it as a signal of where we are right now?